Welcome to the second part of our controversial investment theories video, where we look at the strange theories that some investors come up with to try and structure the dynamic world of investing. In our previous video, we talked about some examples of technical analysis theories, like the 50% rule and broader macroeconomic theories that shape the securities market, like the efficient market hypothesis. If you have not checked that video yet, I recommend you do it after watching this one. There are plenty of strange, curious, and academic theories that try to explain the world of finance. Some might work, others might not. This is not a video about investment strategies that you should follow, but rather about the strategies that some investors have articulated. Note that following any of these strategies without individually researching certain stocks will open yourself up to tremendous risk. And that largely, I do not believe that any of these are 100% accurate. Once again, let me warn you that this video is not meant as financial advice, of any kind. If anything, these theories could be warnings about the ways in which the human mind tries to build order from the chaos of the market. The reason many investors might come up with such concepts and strategies is largely due to the inherent limitation that individual investors can have in the broader financial market, and how difficult it is to truly accept the fact that very few people in the world have a truly holistic understanding of the securities market at any point in time. These theories, like the efficient market hypothesis, the greater fool theory, or some of the other ones we will look at today, are blanket statements and operational guidelines that cannot possibly succeed in a large enough degree of certainty. But why do people come up with these sort of hypotheses? The blanket statements at the core of some of these theories, like the market is always right, or a stock in an upward trend will lose 50% of the gain value before recovering. These are just like pacifiers for our brains, who simply cannot deal with the apparent randomness of billions of purchasing and selling orders reflected in simple line charts going up and down. So don't fall for any of them, but learn about them, so that you can better understand the way some investors view the market. You may even want to apply a few here and there, but never blindly. With that disclaimer out of the way, let's get into our analysis. The first controversial investment theory that we will look at today is the odd lot theory. The odd lot theory is a simplistic form of technical analysis of a security, whose proponents defend that the biggest indicator of a stock's potential to rise is when the presence of small retail investors is washed away of a given holding. At the core of this theory lie two assumptions about small investors: that they are more often wrong than they are right, and that they add an unnecessary degree of volatility to stocks that would otherwise be a smooth and safer investment. The mechanics to implement this strategy is, as mentioned above, an oversimplified version of a technical analysis which focuses exclusively on one variable: the aggregated amount of odd lots of a given security sold in a short period of time, somewhere around 3 to 5 months. Odd lots are small pockets of stock owned by retail investors who don't have enough capital to hold a large enough number of stocks of a company to influence the price. The dangers that defenders of odd lot technical analysis are trying to minimize is the impact of those supposedly ignorant and panic-prone retail investors, and instead side with whoever is left invested in a security once they're all cleared out. Generally, larger investors, like particularly wealthy individuals and investment funds, or other financial institutions. Once again, the rationale of this theory seems sound at first glance, even if a bit elitist. However, a study on the impact of hype or deliberate overexposure to news about a particular company by Brand M. Barber and Terence Odean did show a correlation between the amount of information received about a company and increased purchase sentiment in retail investors. They hypothesized that individual retail investors are likely to be net buyers of what they called attention-grabbing stocks. They also were able to prove that retail investors made almost twice as many purchases as sales of stocks that were considered hot in the market, essentially securities with an unusually high trading volume. They also discovered that individual investors were disproportionately more likely to be net buyers of both the previous day's big winners and losers. These findings do back up to a certain degree the underlying assumption of the odd lots theory, which fears this easily influence investors making irrational, reactive choices could compromise their desired upward trajectory. However, all of this is incredibly dependent on the fundamentals that underlie a stock. It is possible that odd lots theory might bring more stability to investments in the short run. However, the underlying fundamentals of the company will ultimately decide if the investors that left the stock in the short run were right or wrong. Small investors aren't going to be right or wrong all the time, and so it is important to clarify what is behind every increased odd loss short uptick. Is it born out of a low risk tolerance on the side of uninformed, scared investors? Or are there some underlying reasons that larger investors might be ignoring? This might seem impossible, since big funds and large investors are generally exceptionally well informed about the fundamentals of the assets that they gain exposure to. However, the truth is that retail investors are tremendously more mobile and adaptable than larger players, and so can respond to the early signs of a catastrophe and be the first one to avoid it, while larger fortunes are still scrambling to pick up the chips from the casino table. The second theory that we will look at today is the prospect theory. This investment framework warns investors that perceptions of gain and loss are skewed, and that a particular loss will be more painful than a win could compensate for. This theory is an extension of the psychological theory of loss aversion, and it is a fundamental and utterly tested notion that influences the stock market. Obviously, investors want to reduce the risk that they expose themselves to while maximizing the gains. However, the incentives in a free capitalist system are distributed the complete opposite way, where some of the most risky ventures hold the largest upside potential. The prospect theory warns that psychologically, humans are biased towards safer investments and early profit making. However, I do think that the prospect theory does lose some impact when larger time frames are considered. For example, in the short run, it is rational for investors to worry about the risk and decide to go for a safer investment that pacifies their craving for safety. But if larger investment periods are considered, and a good fundamental analysis of a company is undertaken, larger and larger perceived risks can be mitigated. Value investors like Warren Buffett and Phil Town have made their fortunes by braving the risk of stocks with high potential and holding them for a long period of time, allowing the risk to dissipate every year as the previously considered risky securities become safer and safer, as they get richer and richer. This is, of course, not to say that holding a stock people are afraid of at the time of purchase for the long term will result in a profit. Not at all. Sometimes fear is well justified, but it must be weighted against the most objective notion of potential that investors can find. And while financial analysis and expense reports can vary over time and be misleading in the present, fundamental analysis still remains supreme as a bridge between what is now and could be tomorrow. Once again, the theories we have looked at today have at their core an inherent psychological factor, that is, the irrationality of other players in the market. Both seek to protect investors from those who might alter the natural evolution of a company by virtue of overselling, thereby devaluating an otherwise good investment, or overbuying, making a lacking security seem more attractive. The complement that I recommend to both of them is a fundamental analysis. Yes, humans are biased towards loss aversion. However, we can strengthen our rational muscles by going against the tide of safe investments by performing a careful fundamental analysis prior to taking blind risks, and thereby avoiding both the true dangers of a bad investment and the quiet portfolio death that are the assets fearful investors gather at. Additionally, the odd lot theory might have some merits, but the reality is that single variable analysis in almost any facet of life are generally wrong. So focusing on the volume of odd lots sold, while probably a good way for investors to protect themselves in the short run against unnecessarily turbulence, remains only a good tool amongst many to complement a fundamental analysis, but never to substitute it. Thank you for watching Rebel Economics. It was fascinating to explore these theories with you. If you find that you like this content and for some reason you clicked on this part 2 first, check the first video we made about investment theories, right on the I button at the top left of the screen or in the end screen. And for something completely different, why not check out why Google is moving into the health sector? Once again, thank you for being here, and thank you so much for viewing and subscribing. It really does mean a lot. We'll see you in the next video.